The Hershey Company is an interesting dividend stock to consider. Of course, this isn't the type of investment that's going to double your money overnight or in a month or in a year. This is the kind of steady grower that's going to give you yields and capital gains, and you're going to have more in 10 years than you did today. But how much more? That remains to be seen, but it's very likely that if you buy Hershey stock today and you hold it for 10 years, that investment is going to be worth more in 10 years than it's worth today. And so that relative safety of Hershey stock has a lot of defensive-minded investors interested, understandably. So what's a fair price to pay for Hershey stock? That's what I'll answer in this video by doing a discounted cash flow analysis to determine a fair price for Hershey stock. Let's jump in. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So there's 3 sections in my discounted cash flow valuation model: the green section, the blue, and the red. We start off with the green section where we look at forecasts of its free cash flow from Wall Street analysts. That's the section that's shaded in green here. According to Wall Street analysts following Hershey Company, they forecast its free cash flow will grow from $1.75 billion in 2024 all the way up to $2.14 billion in 2028. I know it's not explosive growth. That's not what this investment is intended for. Between 2028 and 2034, I forecast that the company's free cash flow will grow at 5.5% compounded annually to total $2.95 billion by 2034. From 2035 onward, I forecast the company's free cash flow will grow at 3% long term. And throughout this next decade, the company's free cash flow is expected to grow from 1.75 all the way up to 3 billion in 2035. But these are cash flows expected in the future. We want to know what the cash flow is worth today. And to find that out, we need to discount all of these cash flows back to today. And that's where we see the present value of the terminal value of $42.5 billion and the present value of all of its operations at $58.26 billion. This is what Hershey's free cash flow between now and infinity is worth to me today, $58.26 billion. So your next question should be, well, what's the discount rate you used? So let's jump to that section in blue. To answer that question, the weighted average cost of capital I used for Hershey stock is just 6.73%, among the lowest I've utilized for any company I followed. And it's because what I touched on early in the video, the lower risk factor of Hershey's business. Whether the economy does really well or whether the economy does very poorly, it doesn't impact Hershey's sales and profits by all that much. Sure, the company does better when the economy is performing better, but not that much more. It doesn't sell that much more chocolate when the economy is doing much better. And you could argue that sometimes chocolate sales could go up in a poor economy as people want to get those calories at the easier, more convenient, and quicker dose instead of healthier foods are more expensive, harder to come by. And so you can argue that the business is a little bit counter-cyclical in that regard. Overall, though, the company's riskiness compared to the macroeconomy is among the lowest of any company you'll find. The counter-cyclicality of the business is solid, and it does well in typically all or most environments. And so that's why it earns a lower weighted average cost of capital. If I'm evaluating a business that depends significantly on economic growth, for instance, a car business, which is very heavily dependent on the economic cycle, right? If you're evaluating a car business, job growth is a big indicator of car sales. If you get a new job, you're likely to buy a new car. If you lose your job, you're probably not looking to buy a new car. So it's very connected to the economy, almost the opposite of Hershey's. So that's why, to go into a lot more detail than you're probably looking for, the weighted average cost of capital is so low. The cost of debt I've given them is 6.75%, almost equal to its cost of equity of 6.72%, a very low beta of 0.37, and a risk-free rate at 4.5% with a market risk premium of 6%. Its market cap is $30 billion and it has total debt of $5.6 billion. So I've given them a target capital structure of 25% and 75% equity. And so the weighted average cost of capital is 6.73%. Again, just because the beta is so low, I've also looked at 3 other scenarios evaluating Hershey stock with a higher beta. I'll go over those after I go over this base case scenario I've evaluated here. So now let's jump to the section in red where we'll get the intrinsic value per share. We start with the value of operations we calculated in the green section at $58.262 billion. We add the company's cash balance and subtract the debt of $5.6 billion, and we arrive at a value of equity of $53 billion. We want to know the price per share, so we divide by the number of shares outstanding, and we arrive at our intrinsic value per share of $262. The current market price is $155. So, according to this calculation, Hershey stock is significantly undervalued. However, since there's such a wide disparity for a business that's not so risky and not so volatile, I wanted to evaluate different scenarios where the beta is higher, and I wanted to see where the market price would be, where the intrinsic value would be. And the next likely scenario, instead of a beta of 0.37, a beta of 0.75 would mean that the intrinsic value per share for Hershey stock would be $162. So it would still be undervalued, but a lot less so than with the beta of 0.37. And the reason why the intrinsic value goes down when the beta goes up is because the beta is part of the weighted average cost of capital I used to discount all of those cash flows. So with a higher beta, the discount rate is higher, and so those future cash flows are discounted more and they're worth less today with a higher beta. That's why the intrinsic value per share falls so much when I increase the beta. And this model is constructed in a way where the inputs change the valuation because I've embedded those inputs into the whole spreadsheet. And so if the beta is actually 0.85, that would mean the intrinsic value per share is 147. And that would mean more so that the stock is fairly valued. And if the beta is 1, it would mean the stock price is $129. The intrinsic value is $129. Now, a beta of 1 is unrealistic for a company like Hershey because it's a significantly lower risk business. And a beta of 1 means that it's equal to the average business in the S&P 500. Hershey's is not equal to the average business in the S&P 500. It's significantly lower risk. It's just a matter of how much lower risk. Is it the beta of 0.85, 0.75, or the current 0.37, which is the current beta according to Yahoo Finance? Without any adjustments, the beta is 0.37. Only if I adjust the beta higher would the beta be higher, right? Only for my adjustments, just in case I want to give it a higher margin of safety to look at the business with a higher risk profile. So in any case, I feel Hershey Company stock is indeed undervalued. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.